It is no secret that the market is dropping right now, and honestly, tech is volatile, indices are swinging, headlines are very, very loud, and traders right now are very, very stressed. Now, this is very natural, but I'm not stressed in the slightest bit. And what if I told you that all my open P&L positions that are in the negative are still generating me income? And it's not that I don't care that the market is dropping, I just structure my trades like most people don't. Now, most traders only trade the stock market by buying shares at a certain price, and they can only make money linearly when it goes up. If it goes down, they are immediately in drawdown. You're basically relying on at any point that you buy this, that stock has to go up right when you bought it. But if you're doing this on something like Hood, where we just have continued dropping, you're not making money at any point here. And that's the whole point of having a system like I'm about to explain. But instead of buying stocks at market price and hoping they go higher without doing any kind of research at all, I sell something called a cash secured put, or just selling a put. That means simply I'm agreeing to buy 100 shares of a stock at a price that I choose. Now, for making this promise, the market is going to pay me a dollar amount up front for making that promise. It's just as simple as that. This payment is what's known as a premium. And this is the part that most traders don't understand. I'm not ever predicting direction when I do this. I'm getting paid to wait for prices that I actually want, because you can sell a cash secured put right at market value and still get paid, or you can set it to a price that you actually want to own the stock at. And that is what I do. So let's use a real example that I'm currently in now. We'll go over recent price action very soon, but first of all, let's see how this looked like when I was getting into this trade. Now, this is when Robinhood was probably trading around the 120 mark. Now, for me, I'm saying, hey, I don't want to buy it at the 113 to 120 point right now. I want a discount and I want to get paid exactly for making this trade. So again, I'm going to agree to buy 100 shares of Robinhood stock, and I'm going to set where I want to do that at. Now, in this case, I did set that strike price for $108 per share. Now, I'm not spending the money to buy 100 shares out of the gate. What I'm doing is I'm setting aside the money to buy those shares in the case that the stock does come down and assign me the shares. And when we do this, you guys have to remember that we use only contracts. Options contracts are 100 shares of stock. So one contract equals 100 shares. Two contracts equals 200 shares. And you can only do it in blocks of hundreds. You can't do this with 50 shares. You can't do this with 10. You can't do this with 99. You can't do it with 2. So again, recapping, if I want to own Robinhood at $108 per share, I'm going to multiply that by 100, and that's going to give me $10,800. And that's how much of my portfolio I'm setting aside to make this trade. Now, this isn't immediately taken out of my account. I'm not buying the shares immediately at all. It is just set aside and tied up until the remainder of the option has expired. And we're either going to have expired in the money, which is going to be below, or out of the money, which is above. All this means is if the stock comes down to the point at which I set in the time that I set as well, I'm either going to walk away not owning anything if it expires above, but I will get the stock, the 100 shares, if it expires below. Now, again, I'm getting paid to buy 100 shares. You only get paid when you're using 100 shares or more. So all you have to do for this is hop over to IBKR. This is what I use. Go to the options chain. You can select how long you want to do this for. So usually I like doing around 7 days is like a safe spot for me, where I like to be aggressive with it. I want to do, we can set it to puts and calls right now, because now the market is closed right now. So we're going to have some delayed data, but we can just look at puts in particular. So if we take a look, Robinhood is trading at $75 a share. Say you want to own it right at these lows at around $68, $69. We can go and find that on Interactive Brokers here. So $68, $69, and all this means 0.57 and 0.45. This means how much you are getting paid per share. So this, you're getting paid $0.57 per share, or 57 cents per share. So the easiest rule of thumb to remember here when you do something like this is it always works in blocks of 100. So if you're buying 100 shares and you're tying up at a $69 strike price, let's say, that means you are tying up $6,900. But on the flip side, that means if you were getting that, let me go back. If you're getting that 0.57 per share, that means for the 100 shares you're getting, it's 100 times 0.59. All you gotta do is move the decimal place over twice, and you get $59 for those 7 days of holding Robinhood stock. Now, I like to use a 5% rule. If I'm getting the stock at a 5% discount or less, that's where I would want to own it at. So if we check where 5% is, that is around $72, I want to say. We can use $72 as a better example here. So 72, this is where it gets a little bit better here. Robinhood is in a really bad position right now, so the options premiums aren't as good. We can go through another example in another video, but in this case, an example, so 5% from where we're currently trading at, a 5% dip would be at the 72 point. So let's check. So for a $72 strike, you would earn anywhere from $1.14 to $1.21 per share per 100 shares. So if we were doing this again with a $72 strike, and earning, what was it again? 1.14 times 100, you are tying up $7,200 of your portfolio to earn $114 total. So you're getting $114 just to agree to buy Robinhood stock at a 5% discount. And I want you guys to hear me very, very clearly on this. You are getting paid $114 just to agree to buy a stock at a 5% discount. Now you can do this with a 5% discount, you can do this with a 10% discount. It's totally up to you. And with expirations, you can set this farther out. So if we check that $72 level again, for 28 days, meaning you have to hold this for 1 month. So you have 1 month for Robinhood to either stay above, or you have 1 month for Robinhood to come below, and can either just go in between, go below, above, below, above, below, whatever. But all that matters is after that month expires in 28 days, instead of the 7 days, whatever, 28 days, if Robinhood is trading above that $72 mark, you don't get the shares. You just walk away with that amount of money. But if it's trading at or below $72, you are receiving 100 shares at that $72 strike price. But the difference is here, the farther you set your strike, see $72, $3.7, all you're doing here, you can keep the math the same because it's still $72 strike, but all you're doing is changing the amount of premium that you're making. So it's going to be 3.7 times 100. Remember, because it's this amount per share and we're using 100 shares, that's $370 you're earning for 1 month, that you're agreeing just to buy a stock at a 5% discount. So obviously stocks are meant to go up. That is the natural function of them. If they are not, they're certainly not innovating. So I only do this on stocks that I like, and this is what I have to assure you guys that you have to do. You should not be running something like this on stocks that you don't want to be holding for the long term. I only do this with a bunch of due diligence on stocks I want to hold for the long term, stocks that I believe in, stocks that I've done insane amounts of research on. But again, recapping this, if the stock stays above that $72 mark, whether it's 7 days, 14 days, or 28 days, nothing happens. Your contract expires, you keep that money, and you never buy shares. Your capital is freed up again. That $7,200 is released back to your account, but that $114 is immediately debited to your account when you make the trade. Capital's free. You can do whatever you want. You can run this again on Hood. You can do this on a different stock as well. Now, scenario 2, that if we did drop to that $72 strike, you're going to buy 100 shares at that $72 strike, and you still keep this $114. So your effective entry is just slightly lower than the $72 mark, but you entered at a discount and got paid to do it. Now, scenario 3 is where this does get dicey. If the stock does drop even further, now let's say it dropped to like $55, most traders would be very emotional. I am not. This is where my plan becomes even better and I start income generation on this open P&L. So what's the key difference here? The key difference with everything that we're talking about here is we're always acting in terms of blocks of 100 shares. So we'll use one contract for this example, meaning 100 shares. So now I effectively own 100 shares at the $72 mark. So remember, I used a put to enter the trade. Now to get out of the trade, we're going to use something called a call, but it's a covered call. So again, cash secured put for down, covered call on the way up. They're just the inverse of each other. So while we earn money for making a promise to buy stocks on the way down, we are making money for agreeing to sell stocks at a higher price using the call. So again, all this means is we are agreeing to sell the shares at a higher price. And once again, you're getting paid upfront from making this promise. So even if the stock was just consolidating, even where you own it from, you can still sell these and generate income. So how does this work? If we go back over to Interactive Brokers, we can switch from puts now, we can switch to calls. So pretend we own the shares at $75 because this is where Robinhood is trading right now. So what you would do is you would find an expiration. With calls, I usually like to run at least 2 to 4 weeks out just because it gives the stock a good amount of leeway to go up. But the cool part is about calls is you're not just earning for agreeing to sell the shares. So if I say, cool, we're trading at 75 right now and I own the shares at 72 and I agree to sell at 85. Okay, let's use this as an example. So 85 is up here. We own the shares at 72, which is right here, 72. And now we have from here to go. So your cost basis is effectively at the $72 mark. That is almost a 20% increase in share price if we get up to $85. Now, on top of the 20% increase of the share price, again, you're agreeing to sell the shares for a premium. So if we go to 85, as you can see, let's do a month. Actually, let's do 2 weeks because I do like to run like 2 to 4 weeks. I'll show you guys both examples. So we're earning 1.04 per share again. So 1.04, we'll just rerun that math times 100. You're making $104. Don't mind my really messy writing here, but you're earning $104 just for agreeing to sell the stock. Again, you're just earning money to agree to sell the stock at a price that you're choosing, and with a 20% gain. Remember, from there to there is a 20% stock gain. From the 72 to 85, it is 20% in shares gain. So you're making a 20% share gain, and you're making an extra $104 for just agreeing to sell the stock. Now, in a market like this where Robinhood is continuously dropping like this is where I would run a longer period covered call. So around a month, I would say. And for this, you get paid even more. Look, you make $258 here, you make $211 from here. I'm willing to sell at 85, and I'm going to give it a month's period of time to do so. Now, again, all you're doing is you're checking the premium price, so 2.11 per share, so 2.11 times 100 equals $211. I think you guys know the drill by now. Multiply everything by 100 here because you're always dealing with 100 or more shares. So in this case, you're getting paid $211 on the spot. That's debited to your account immediately. And then you now have 28 days or 4 weeks to wait and see what happens. Now, again, just like with the cash secured puts, you are still, as you were waiting on the way down, you're waiting on the way up this time. You're just getting paid upfront for making the promise. So even if the stock is consolidating again, you're still earning that premium income waiting for us to hit that mark. And this is the big key here because I'm basically monetizing just to wait. Even if the stock keeps dumping, I keep selling those covered calls as we're going down, all the way down. I'm still earning income as it goes down. Now, if this is a company that I want to hold for the next 5 years, I can just keep doing this until the stock inevitably will come back eventually. And then I can sell a covered call on it and get rid of those shares for a profit. But I've been earning all the way down. So let's say the stock was trading even lower in a case like this. Say we were trading all the way at $60 here. So we're still selling covered calls at a higher level. But even though the open P&L might show red here, the account value is still rising because we're collecting the put premium and we're collecting the call premiums. So if I ran this for 1 week in a case like this, then I ran it another week. I ran it another week. Now I'm 4 weeks just running calls and owning the shares, and we are kind of dipping. Now we're starting to consolidate. I'm just collecting premiums over multiple weeks now. This is the part that traders don't see. Open P&L is one thing where your balance is going like this, but your total equity will be going like this. Now, when price is going to approach that break-even level, I don't just sell this at break-even like we said. We sell an in-the-money covered call and collect a larger premium and guarantee the exit here. And this is where we're getting paid to close the trade with that covered call. So again, this completes the cycle where we get paid to enter on the way down, we get paid while waiting, and then we get paid to exit. But remember, options do matter with how you pick your expiration. So you can choose how long those contracts last. As I've said, you have your weeklies, you have your, bi-weekly, you have 3 weeks, 4 weeks. You can do that all the way in advance. Farther expirations obviously pay more upfront, but they lock in your capital for a lot longer. So personally, with me looking at the market every single day, I do prefer weekly expirations just because I can adjust my strikes faster. I can be more precise with them, and I can target roughly around 1% per week on premiums alone. And that doesn't require insane accuracy. It just requires a good amount of due diligence and obviously a stock being in the right spot. I will never sell this or start a trade like this when we're trading at all-time highs. I want to see us trading at a certain level. I want to see support levels. This isn't a good example. I can hop over to, like if we were looking at Google, we have key support levels right here and right here. So I would love to sell a put maybe at this level because then we are in between two key support zones. So we do have a good odds that if we did get assigned the shares at this level, we could have that recovery, and then we can sell a covered call here. So we make income on the way down, we make income on the way up, and then we get paid to exit right here. I will say if you are newer to this, starting with 2 to 4 week expirations is what helped me because it gives me more time and it gave me more of a cushion and there's just less pressure. So the best part about this is this works in volatile markets. So I love using this, especially when markets get shaky and direction becomes harder because fear is increasing, volatility is rising, and volatility increases those options premiums. So these numbers that you see right here are actually more inflated when there's more volatility in the markets. So this means I just get paid more for the same promise while most traders are struggling in their uncertainty. Option sellers do benefit from this way more if it's structured properly. And again, this only does work if you actually like the stock and you're okay with owning 100 shares and you diversify. And that is the key here because you don't want to be putting your entire account into one name. Like I said here, if you're doing a $72 strike here, you need $7,200 and that should never make up more than 5 to 10% of your account. So you do have to stay very, very spread out from tech, healthcare maybe, with whatever you want. None of this is obviously financial advice, but never keep your eggs in one basket. That's always the key here, especially in the stock market. If you're starting small too, one position could literally tie up most of your capital. So position sizing matters very, very much, and stock selection matters even more. And the most of all, discipline matters the most. So to recap this, most traders really only have one way to win when they're buying a stock at market value. It just has to go up. But I have three. I make money when it goes up, I make money when it goes down, I make money when it goes sideways, and when there's a market drop like this, I don't panic. I'm still getting paid. The market can be emotional, but your structure should not be. If you're building your trades correctly, volatility just becomes your income source here. I hope you guys enjoyed this example because Hood is a stock that I'm currently in, and I'm just doing this as we go along right now on Hood. So hope you guys enjoyed this example. If you have any stocks you want me to break down or, run this same method on other stocks, I can definitely do that. But if you learned something, make sure to leave a like, subscribe, leave a comment below with any questions you might have, and we'll see you guys in the next one.